Okay, so good afternoon, everyone, and welcome to the third Rainmaker webinar today. My name is Stefan Buerter, for those of you who haven't joined us before. And today, the topic we're discussing is very much property investment 101. So thanks to all of you who have joined us. And we've had the highest number of registrations that we've had for any of our webinars. I think it really underlines the interest in this specific topic. And we really want to appeal to two different segments: those who are entering the market for the first time and really want to know anything about investment, how to go about it, how to get into the market, what to look for, what are the costs, etc. But then also really want to give unique insights to people who have invested before and have existing portfolios, and really in this current market, how to grow those portfolios and really what to look out for. And we've really got quite a balanced panel: developers, lawyers, mortgage originators, people on the media side, and obviously a short-term rental specialist from overseas. So we'd like to have you guys. And then obviously we just want to walk away here with those of you who either first-time buyer or investor, to walk away with stuff that you didn't know before. And I think that's really the essence of these webinars, and to really keep it honest and transparent and relevant. And we really want to encourage engagement between the different panel members. We want to keep it relaxed and informal. And I think it's quite interesting. I don't know if many of you know, but currently, in terms of recent buyers, if we look at the last 12 months within Ballito and Umhlanga, which is obviously quite prime areas, especially in KZN, 25% of those recent buyers are under the age of 35. And then if one goes further afield to like an area like Midrand, for example, which is heavily driven by guys like Warwood and M&T, who obviously bring in specific product within certain price points. Midrand, 42% of the recent buyers are under the age of 35. And then lots of other areas. So it just shows how the younger market really does drive the property investment currently, and how much more savvy people are about getting into the market early. And we really feel there's almost like a holistic responsibility to be educating younger buyers more about the purchasing process. And I think the more they understand about the process and listen to the likes of a Graham or a Kay or a Charles, or whoever it is, it really makes the whole process seem a lot less onerous and a lot less daunting, and really understanding how by utilizing banks' money and various different things, it is actually a very different process. And I think it's just important to understand that we're very, very sensitive about the current situation that we surround ourselves in. We are in unprecedented times. It's very, very tough. And I know people across the board are struggling. I think the thing about property is that there are, if you look at people who've been successful in property, they have capitalized when the market conditions have been the most favorable. And obviously COVID has got its own implications, but when one looks at true market conditions at the moment, in terms of interest rates, banks' ability to lend, et cetera, the conditions probably haven't been more favorable in a long period of time. And I think a lot of people understand that the property market goes through various cycles. So I think today we really want to equip you with all the different tools you need to be able to make the most strategic decisions for yourself or for family, or whatever it may be. So I think just a couple of things in terms of internet, I have mentioned before in the seminars, is that if your internet connection drops for whatever reason, please just go back onto the link and log back in. It's quite a simple, easy process, and we know that internet is unpredictable at the best of times. And then the same with the panel. If panel lose their internet connectivity, all I'll do is just shift their question onto someone else, and then we'll join up with them once they are back in. So if you see guys with frozen expressions on their faces, you know what's happened. But I think just again, a very big thank you to the panel. I know you guys are giving up the time, and we really, really appreciate the caliber of who we've got around this virtual table today. So just by introduction, Charles Thompson, who's the director of the Devemco Group. So Devemco are massive drivers, Charles, of the Sabaya Coastal Precinct, and just within that precinct alone, have delivered over 700 residential opportunities within that precinct. So just to give you an indication in terms of what they've done in that area between Ballito and Umhlanga. Then Kay Haldenace, who is the National Origination Manager for Uber. And for those of you who don't know, Uber are South Africa's largest bond origination service. And for those of you who are saying, what is a bond origination service? You'll find out sooner rather than later. And then Graham Phillips, who's the Director of Garlick and Bousfield. I certainly didn't know, but Garlick and Bousfield have been going for 153 years, which is a hell of a thing. And it's just a testimony to the team. And in terms of land transactions and conveyancing transactions done within KZN especially, they certainly have been responsible for the major land transactions in KZN and obviously further afield. Then Chris Horn from Avoca Developments, Chris, and they've delivered a broad range of developments across the board in terms of various different segments, high-end, affordable segments, etc. And then a man who needs no introduction, who's the sales strategist for the Collins Residential Group, Pat Landry, who's a Springbok legend of 56 caps. So I know Murray Collins was part of our retirement panel last week, and Pat joined the Collins Group about a year ago and really has been pretty instrumental in their master plan rollouts throughout KZN, especially their very strategic vision from Sheffield Beach North. So thanks, Pat, and really a very interesting story in terms of your journey in property, and thanks for joining us today. And then Michael Allen, who is the co-founder of Altido. So Mark's joining us from Scotland. And just interesting enough, so Altido currently manage 2,500 short-term rental units across the US and Europe. So they are the biggest short-term rental operator in Europe. And their model is basically to utilize the platforms of Airbnb and Bookings.com and various other platforms to provide a solution for short-term rental units. And 750 of those are specifically for developers, where they provide a solution for developers to help maximize the yields for investors within developments. And we'll obviously chat to Mark in terms of their movement and their thoughts on the tourism market as a whole, but also specifically around South Africa and why they're so bullish about South Africa. And then Vivian Warby, who's celebrating her 21st birthday today. Vivian, happy birthday. But the executive editor of Property360.co.za, which is basically the former, it's the online portal of, well, the formerly the IOL online. So Vivian, thanks very much. And obviously you've got your ears very close to the ground in terms of what's happening within the industry as a whole. So I want to jump straight into questions. Kay, I want to go into you. I think the beauty of property is, you all know, we can use banks' money and we can leverage that. And we also know that very few people can afford to actually purchase the property without getting a bond from a bank. And I think the first question for those who don't know anything about lending or origination, what is a mortgage origination service and what value does it add to the person who's buying?
Thanks, Steph. Thanks for inviting me to this panel discussion. Looking forward to participating. So a bond originator is, in fact, a home loans comparison service is what we offer home buyers. So we offer a free, no cost at all to the home buyer, convenient and hassle-free service to access, for our company, up to 9 lenders to obtain the most competitive home loan deal. So having the ability to multi-submit to all banks simultaneously, you basically giving home buyers an ability to shop around for finance without doing any of the legwork themselves. We're obviously experts in bank lending practices, so we can give a huge amount of advice to home buyers, and particularly new home buyers, first-time home buyers, find the service of an originator, home loans comparison service provider, really, really integral in their journey, buying a property to securing home loan finance. Steph, I mean, our service doesn't only include securing the home loan, it also goes to the point before the journey of purchasing a property actually even starts. So we have many home loan tools, online tools, where a home buyer, prospective home buyer, can pre-qualify themselves and basically, you know, understand what their credit profile looks like, what kind of price range they should be shopping around in. So when they eventually sign their offer to purchase with a developer or a real estate agent, getting the bond is basically a mere formality. So getting the most competitive home loan deal at the best price is obviously, you know, really, really important. And we, through our ability to multi-submit, you know, we provide our home buyers with a choice of quotes from the lenders and guide them in, you know, accepting the best deal that suits their particular needs.
Okay, no, perfect. And then, so Kay, I think everyone's talking interest rates at the moment. And I think those who don't necessarily understand property buying might not understand what an interest rate is, and might not understand the implications of the interest rate being the lowest it's been in 47 years. And I've mentioned that a few times. And effectively, for those of you who don't know, it means that the rate at which you borrow from the bank when purchasing a property is the lowest it's been in that period. So I think just from your side, Kay, what implications does that have for a buyer financially?
Right. So, I mean, quite right. The prime lending rate of 7.75% is the lowest since 1973. And most of our audience probably, weren't even born in 1973. What it means to home buyers, so if you look at your existing borrower's cost of servicing all their debt, not necessarily only their home loan, is a lot cheaper. So if you look at what our interest rate was in March before the first 100 basis points drop, it was 9.75%. And if you compare a R1 million home loan to the saving at the current interest rate of 7.75%, it's about a 1,300 Rand saving, and across a 20-year loan term, it's over 300,000 saving in interest. So the 200 basis points drop that we've experienced in the last 2 months has had a profoundly important impact on borrowers' net surplus income. So for a new buyer, it basically enables that buyer to qualify for a higher loan amount than they would have qualified for in March, because all the existing debt is a lot cheaper. So their net surplus income at the end of the day is a lot higher, which allows them to look at a different price range. So I mean, very good news, amongst all the lockdown gloomy news.
Okay, and I think if one had to equate that to someone, I think for someone who's lending R1 million, for every percentage drop we get, that person's effectively his repayments per month effectively 1,250 odd Rand less. So where we've had 2% interest rate drop, those people are effectively for R1 million paying 2,500 Rand less a month at the moment, which is pretty significant.
Absolutely.
And so Kay, I think that the big question we all want to know is how are the banks going to respond going forward? Are they going to be under more pressure to lend? And are we going to see further interest rate cuts between now and the end of the year?
Yes. So Steph, I mean, we're very confident. The talk is that the Reserve Bank, the South African Reserve Bank, is under huge pressure because of the current economic conditions to keep the rates as low as possible for as long as possible. So the economists are indicating that we would be looking at another 125 basis points reduction before the end of the year. And that is definitely going to be, a huge kind of benefit to prospective home buyers and existing borrowers who obviously, are mostly under severe financial stress. But clearly after the next, spate of rate drops, we are going to move into an upward rate cycle. So Steph, right now, what our banks are doing, I mean, they're celebrating the 7.75% rate, but they are stress testing borrowers. So what I mean by stress testing borrowers, it's looking at whether this new borrower could afford the same home loan if the rates went up by another 150 basis points to 200 basis points. So it varies across the banks, because some of the banks, if it's a really strong risk profile client, they wouldn't bother stress testing. But that's kind of what's happening at the moment. And Steph, I think we're also getting a lot of questions from our new borrowers. Should they fix their rates or not? So I'm sure that's probably a question that you wanted to ask. Yeah. To fix or not to fix. So when you're in a downward rate cycle, it's not the best option to fix your rates. You would want to fix your rates if you're on a very tight budget and you can't, absorb any price rate increase. So for those buyers, who really don't have a huge kind of potential income increase over the next couple of years, they may want to fix their interest rates. But, clearly, your fixed rate is a little bit more expensive than your current variable rate. And, our advice to borrowers as well is banks are competing for home loans. So they're giving, they're lending at prime, less a concession depending on your risk profile. And the problem is that when you fix your rate and after your fixed rate term has expired, so fixed rate terms range from 12 months to 5 years, you have to renegotiate a rate. And you're not necessarily going to, in 3 years' time or 5 years' time, be in a position to renegotiate a really good rate concession, which most of our borrowers are currently enjoying. So, when is the right time to fix? Well, the right time to fix, is when rates start moving upwards. But you generally find at that stage, it's kind of almost too late, because then your fixed rates that the banks offer are hugely higher than the variable rate. So, so basically it's up to every individual's personal situation, tight budget, then you may very well want to start, looking at fixing your rates before we see the end of the next rate drop cycle.
And then Kay, just one last question. So obviously we know one of the biggest barriers to entry for any purchaser is a deposit amount up front. Traditionally, banks have always been 10% deposit up front. I know you've written some articles about 100% bonds with no deposit. Is that something that's going to continue? And does that only apply to first-time buyers, or can it apply to people who've got existing investments?
So Steph, the 100% loan product at the banks, it's really been a very popular product, and particularly around your first-time home buyers. So we have seen unprecedented lending at the 100% lending threshold in the last couple of months. We don't anticipate, once lockdown's over and banks start reviewing their credit lending policies going forward, we don't foresee that the 100% bond product will be removed off the bank shelves, which is what they did with the global financial crisis in 2009. But we do see them making it a little bit more difficult for buyers to qualify for 100%. So, you're probably looking at 100% bonds being very available for first-time home buyers, because they don't really have a property to sell, so access to deposit is more difficult, and particularly in the affordable lending space. And affordable lending, we're not talking about the FLISP, the government subsidy affordable lending income segment. It's more around the 24,500 category. So we anticipate they'll continue lending to that market, and also to the young professional market, which a lot of upwardly mobile young first-time home buyers fit into. So they'll look at young professionals who are in industries where there's sustainability of employment and of income going forward.
Okay. No, that's great. Thanks. And I think all the developers, Chris?
Just a quick one, Kay. Now, do you have any idea of current fixed rates? I actually have no idea.
Banks are not that keen to discuss their fixed rate options, because they're only available on bond registration date. So, if you take a new home buyer to a bank now and ask for a fixed rate, they won't give it. They'll register the bond with a variable rate, and then at that point, on registration. But I have kind of done a little bit of mystery shopping myself, and you're kind of looking at a 3-year fixed rate at 11.25%. So
they're pricing it in, the escalation.
No, absolutely, yeah.
Okay, perfect. I know there's one question unrelated just comes through from anonymous attendee. How does property viewing happen under the lockdown conditions? And I think I'll just jump on there. I think that's obviously one of the challenges we face currently in terms of the real estate market. Wants to get back into action, needs to know, and I think at the moment viewings are all virtual listings, which is having an impact in terms of sale agreements being subject to viewing. And it's obviously a big thing for the industry for people to be able to get back out, start viewing and start concluding deals. So Graham, I just want to bring you in here. So obviously the legal people are always the important people in the process. I think obviously you've seen every single scenario, but I think one of the big things is if you're investing, there's so many different ways to invest. You can invest personal capacity, trust, company. What is the best? And each one obviously has its capital gains implications and so forth. What would your recommendations be? What scenario applies to who?
Yeah, look, there's no one answer fits all. Each depends on each person's specific circumstances and where they are in the market and where they are on their career path and their age, etc. But as a general bit of advice, if it's a first-time buyer, specifically somebody buying for a home to live in, then undoubtedly they should put it in their personal names. Okay, primarily to get the capital gains tax rebate of 2 million rand when they sell it as their primary residence. So that to me clears all other advantages of all other entities. Okay, if you're buying a second property, perhaps as an investment, even then you need to think quite carefully about setting up complicated structures. Okay, try and keep it simple, because when you set up these structures, you've got to pay for them. Okay, so for example, if you decided you wanted to put it into a company for no reason other than that's what you thought you should be doing, you'd be incurring audit fees. Okay, and bank fees are generally more expensive for companies. So even though you're the same individual and you're buying it in a company, I found that the bank usually won't give you as good a rate, and their banking fees per month are higher. So if there's no reason to put it in an entity other than your own name, then go that route. You know, there would be occasions where perhaps if you intend keeping the property for a long period of time, second property or third property, you may want to consider a trust. But again, that's an estate planning tool, so it really depends where you are on the wealth ladder, as it were. But I've seen a lot of people go to a lot of expense to set up fancy schemes and to go into property ownership in various vehicles that really don't have much benefit and just have the converse, have added complications.
So basically, keep it simple wherever you can.
Keep it simple, yeah. Keep it simple. Especially your first-time buyer. Undoubtedly, you know, it needs to be in your personal name, in my view.
Okay, perfect. And then, Graham, so I think a lot of things, well, one thing that a lot of serial investors, guys who've invested in more properties, don't really understand that there's a income tax act called Section 13(6), which is obviously a very risque word for SARS. But it's obviously an incentive for people who are planning to purchase or have purchased 5 or more properties that are, I think, off plan or new directly from the developer. Is that a big advantage to investors?
Look, it's not really that much of an advantage. I wouldn't, after explaining what it is, I wouldn't go specifically and buy property to get this advantage. If you happen to fall into the category, then it's a nice to have. But basically what it provides is if you acquire an unused new residential unit, okay, and you let it out, and you happen to have another 4, so you need to have 5 new unused units, okay, then you're entitled to a 5% rebate, 5% on your tax every year, okay. But it is subject to the proviso that if you didn't build the units yourself, and if the unit forms part of a block of buildings, then you're only entitled to the 5% on 55% of the market cost. So basically half the purchase price, you're entitled to 5% of that. And it does come with various complications. So that's not in itself, to me, a tool for your acquisitions. If you happen to fall into the category where you happen to own 5 residential units all let out and you acquired them all new and unused, then claim the rebate. But it's quite interesting, you know, it's quite interesting if you go through the list of rebates that are allowed in terms of Income Tax Act, you can get some ideas, different ideas. There's a whole lot there that a lot of people aren't familiar with, which this is one of them.
Okay, perfect. Thanks, Graham. Okay, just one quick question for you from another anonymous attendee. Can I negotiate for a fixed rate when you already have a bond in place?
Yes, absolutely. So you can definitely. The banks will only issue a fixed rate if your bond's already registered.
Okay, perfect. And then, Graham, I think obviously we all know that the big benefits of buying off plan is you don't incur transfer duty. Yeah. And I know that the transfer duty threshold has been lifted to under R1 million for those who are purchasing off plan. But in terms of other costs, other transfer costs, there's obviously sometimes people don't really necessarily understand what the implications are prior to transfer. Can you maybe just touch on that quickly?
Yeah, so obviously if you're buying off plan, you're buying from a developer, and the developer will be VAT registered. And because there's VAT included in the purchase price, there's no transfer duty. So there isn't transfer duty payable, so that is an advantage, but you are paying the VAT. Okay. So over and above that, though, you'll be paying your conveyancing fees. Okay. And just as an example, on a R1 million unit here, you're looking at conveyancing fees of about 19,000 plus VAT. And then if you're paying you're getting a bond, depending on the amount of the bond, if you're getting a bond for R1 million, that's probably the same amount again. So you need to be aware of those, obviously, those type of costs before going into a development. Certain developers, particularly in the more affordable end of the market, do roll up the transfer costs into their purchase price, but it really is at the affordable end of the market. It's not something that's normally done sort of the middle upper echelons of the market. Yeah, look, first time home buyer, obviously sectional title is, just to deviate a little bit, is obviously the way to go, in that your expenses are more fixed. So you can get a good estimate up front of what you're going to be in for with regard to your levy and things like that, maintenance costs, and that all rolled up for you.
Okay, perfect. Chris, I know you want to come in there.
Yeah, I was just going to ask Kay, you might be better positioned. What is the bank's attitude to capitalizing those legal fees now? I know at one stage they weren't that keen. They wanted the owners to, what is the bank's attitude at the moment?
Yeah. So, I mean, a few of the banks have a cost-inclusive product, and it is subject to certain conditions. One bank would want to only offer a cost-inclusive product to first-time home buyers. Another bank would only want to offer that product to young professionals. So far, we have seen one bank withdraw their cost-inclusive product in the last week from their shelf. And, the jury's out, as to whether your cost-inclusive products are going to survive with all the other banks, depending on, the extent of banks' bad lending book going forward. But right now, if you applied through Uber for a cost-inclusive loan, we could certainly secure it for you from one or two of the banks.
Thank you.
Perfect, thanks. And then, so I know there are a lot of questions coming through, guys, so I am looking at them. I think a lot of these will be covered through the panel as we go, but if we don't get to them, then obviously we'll try and allocate those at the end. Charles, I mean, I'm going to get to some questions for you, but just there's one question here. Given the changes in mobility, when do we expect construction to be allowed again? Obviously, the $1 million question.
Mm-hmm.
You're on mute.
You're on mute.
I think the construction sectors, obviously that's what everyone's waiting for, and it's once again going to be dependent on whether you're catalytic or whether you're a large scale commercial project. We're hoping that it'll be sooner rather than later, but sort of our intel, we reckon in the next probably 2 to 3 weeks, we'll see a commencement, and it won't be full. It'll probably be a staged, operation startup, so 50%, and then gaining a bit of momentum as the lockdowns end. So in terms of full, I don't know. I mean, I would say my gut feel is probably 6 to 8 weeks, in terms of being fully back.
Okay. So Chris, and I know you've always got a lot to say, but I think we, as marketers, we love talking net rental yields. It has quite a big impact, and it really has a big effect on how people take on their purchasing process. I know in the entry-level estate side, you've always spoken about how the yields are exceptionally high in that segment because the purchase price is slightly lower. But we also know that if you are someone who's investing and you might be primary residential initially, you always want to know that if situations change, you'll be able to rent out that unit. And then there's always the additional thing where if it's a strategically located development, there's possibly the hybrid between short-term rentals and long-term rentals. Can you, in a very short nutshell, explain what a rental yield is?
Net rental yield.
Correct.
Okay, so the concept is it's a return on your investment, okay, after deducting the annual costs. In layman's terms, take your annual rental that you're achieving off a unit, less your operating costs. What are operating costs? Things like rates, levies, if you're in a body corporate, if not, security, insurance, maintenance, vacancy factors, and rental management. get that figure, you divide that by the purchase price, and that is your rental yield, or it's your return on capital.
So what's a good rental yield percentage?
Well, it depends what sector. So in the upper end of the sector, you're probably getting 4, 3, 4, 5, 6%. Going up to the affordable sectors over double digits, which is very good. Obviously, commercial is a different discussion. I'm just talking resi here. But those are the kind of yields you're getting versus other asset classes, other investments that you can pursue.
Yeah, okay, perfect. Just to elaborate there, so your net rental yield is basically your rental income after you've deducted things like rates and levies, etc., as a percentage of your purchase price. Correct. So Charles, there's obviously always a debate between capital appreciation versus yield. And some might say you got to choose either or. Can you find a hybrid between the two?
Yeah, well, look, I mean, I think, you know, the sector that Chris is talking to is, it's not your entry level, it's sort of your lower middle income level, but high demand. So you're getting really good rental yields, net rental yields. It doesn't mean to say that the capital growth is not there either. Capital growth will continue to grow. Maybe it's 5 or 6% versus a higher product at 7 or 8%, but yet again, you're getting a lower net annual yield on a higher valued property typically. So I really think the balance sits, you know, probably in, you know, primarily it's location. So location for me is the overriding factor, because that's where we see capital growth. It's always to do with location. So I would say it's probably in that region of 1 to 4 million rand properties. That's sort of the sweet spot. As soon as you go over that sort of 4 million rand, you start really struggling with your income yield, your net income yield that Chris was talking about. That drops significantly, and then also your supply in a lot of ways outstrips demand. So there's not a lot of guys out there looking for 6, 7 million rand apartments. So your market that you're trying to catch is significantly smaller. So yeah, the answer to that is probably somewhere in the 1 to 4 million rand range, maybe up to 5. And it's that blend of, you know, immediate cash year on year versus capital growth.
And the question I'm sure a lot of people are asking is, can one still get capital appreciation in a tight market?
100%. I mean, I think, you know, what we've been talking about interest rates dropping, and I've done a couple of these discussions over the last couple of weeks on, you know, money sitting in the bank. You know, we're all talking about how great it is to have some debt relief on, you know, lower payments on your debt, but guys sitting with cash in the bank are earning less. So, you know, property at the moment, you're getting your, let's call it somewhere between 5 and 8% growth in the type of properties we're talking, whether they be lower end or mid end or high end, but they're all estates and they've got their own security and etc. So that's sort of that 5 to 8% growth, plus the yields Chris is talking of, which I would concur with, you know, somewhere between 4 and, let's say, conservatively 9% as a net, you know, annual yield. You add those two numbers together, and it's a significant number, somewhere in the region of 10 to 14%, versus probably a net return of maybe 3% on cash and bank. So yes, definitely property is a significant player at the moment in the investment space.
Okay, and just a quick last question there. So obviously, I think stats across the board suggest that properties within estates appreciate at faster rates than properties outside of estates. What's the reason for that?
Yeah, I think there's a couple of reasons, but predominantly security tops it. You know, security, convenience. A lot of the lifestyles we're living now are more convenient orientated. So guys don't want big gardens. They don't want to be cleaning swimming pools, having these high running costs. So you see a big move towards convenient based living in secure estates. And that doesn't have to be secure freestanding plots. Talking about apartments, condos, a blend of duplexes, freestanding. So it's anything that's contained, convenient, and secure. That's why we're seeing a big spike in that, because there's demand for that. And then on the other side of the coin, when you've got these, you know, larger freestanding properties, high maintenance, high running costs, potential security issues, we're seeing like a degrading in the property value of those. It's either staying quite stagnant or it's ticking up at 1, maybe 2%. A lot of areas are dropping. And typically the estates or secure new builds, we're seeing at between sort of 5 and 8% growth. And that's significant when you run it against, say, a 2 or 3 million rand investment, and you run that differential over a 10-year period. It talks to big numbers.
Okay, perfect. Pat, I know a lot of people are probably quite interested in terms of your personal journey. I know many might not realize that you've got quite a long history in property through family, etc. And I'm quite interested, how did that journey happen from sportsman into property investor, now obviously make a career within the property industry?
Yeah, thanks, Steph, and good afternoon, everyone. As you mentioned, we've got a family business in property, so it's always been the conversation around the dinner table, rugby and property. And I was very fortunate after school, when I started earning a salary. I was still living at home at the time, and I was given the advice to save up any income that I had in order to put it down as a deposit for my first property, which is exactly what I did. Managed to find a lovely little unit within a secure complex in Durban North, and it was a fair asking price. It was a little bit tired, so there was potential to add some value. Leased it out for a couple of years, lived in it for 4 or 5 years, did some renovations, added a little swimming pool, and started climbing the property ladder. So yeah, I guess property has always been a topic of interest in the family. I was lucky to have been guided into property from a personal investment point of view too, and it seemed like the natural transition after my playing days to get involved into property as a career. And so fortunate to have joined the Collins Group on their residential projects team, and now working on a number of estates and lifestyle estates, secure living around KZN, which I'm thoroughly enjoying.
And Pat, obviously you've come across lots of sportsmen along the way, and you probably deal with a lot of younger sportsmen too, who probably could benefit from understanding the benefits of getting to market early. Do you believe there's a shortage of knowledge when it comes to guys understanding what the benefits are?
Yeah, I think there potentially is a lack of understanding, and I hope that people that have tuned into this webinar today will find it really beneficial. I mean, the tools that we have now, all these online tools, the loan generators, the property searches, virtual tours and tools and things, I think it's a huge advantage. It's making it a whole lot easier to get involved in property, but I'm certainly of the opinion that the sooner you start climbing the property ladder, the better. And in these times, with all other investments seeming extremely volatile, property has traditionally been a long-term steady investment. Looking at yields and capital growth, it's really nice to invest in bricks and mortar. And if you find the right property, you can achieve both of those things, the yield and the capital growth, as Chris and Charles have alluded to, and you can start climbing that property ladder and keep upscaling as you and your family grow.
Okay, perfect. And so just a question here from Sandy Powell-Rees. Missed the company that Pat represents. So Pat represents the Collins Group, and specifically Collins Residential, which is the residential arm of the Collins Group. Mike, so I'm going to bring you in here. So we spoke about rental yields earlier, and we all know that there are certain areas of the country where the short-term rental side is more aspirational, often the stuff that's closer to the ocean, closer to where people work, etc., etc. We also know that the hospitality market is currently in understandable turmoil as a result of COVID-19. And it's going to have an immediate effect on people who've got existing units that they have put on short-term rental basis, either through Airbnb or bookings.com or whatever it may be. Mm-hmm. So what's your take on that side of the market, hospitality industry going forward? And why is it that people are very often in the current market choosing to take a unit on Airbnb, for example, a short unit, as opposed to staying in a hotel?
Okay, yeah, it's a good question. And right now there are lots of new trends that are starting to appear. So I could give you an answer now, and it could change in a few weeks. But the starting point is the travel industry obviously got hit very quickly, you know, with the COVID pandemic, and of course, it's also one of the quickest that then comes back, and especially in the hospitality sector, people are locked up for a long time, and they obviously, as soon as they can, will start to travel again. And we've seen kind of case studies of similar types of situations happen where what happens first of all is obviously people go and they stay closer. So there's these staycations, and then people start to travel more internationally again. So there'll be kind of like a short-term rebound, medium-term rebound, and then back to like a new normal. So to answer your question first, the travel industry was seeing a massive push towards short-term rentals. So in 2020, it was going to be the first year on record that more people would stay in a short-term rental versus a hotel. So the trend of people wanting to stay in essentially non-hotel accommodation. So we manage hotels as well, just to be clear here. So I'm looking at this from a spectrum of, we manage basically independent boutique hotels, not big brands, of course, all the way across to somebody who has an individual property. And it could be in an urban destination, or it could be in what we call a vacation rental destination. And the trend basically is people are shifting into that part of the market. Why? Better value, better locations, more flexibility, more choice, et cetera, goes on. And what we're seeing now with the trend with this disease is that people want more space. And the way that we're going to, in the short, medium, and then the longer term, counteract this disease or any future diseases is we respect each other's space more. So what we're already seeing is that our hotels that we manage are tanking and nobody's booking them. And all of our short-term rentals, and especially the ones that are kind of most spacious, most secure, we can advertise it and show clearly that there's as little contact, minimal contact as possible in the process of staying, booking, and staying in that property, the better. So the trend that I can see happening now is that the trend that was already happening, where there's this basically this kind of niche creating big gap and then being filled in between short-term rentals and hotels. It's like the professional space between your kind of Airbnb host running an amateur operation, which of course has its benefits to kind of like professional hoteliers. So that's the first thing to mention. So the rebound, so as soon as the market picks back up again, I think short-term rentals will become more popular than ever. So with a long-term investment, definitely you need to keep your mindset on what a short-term rental can achieve in a particular area where you have a property. Then I put my short-term rental hat on, we're competing against hotels from the kind of guest side, but we're competing against the long-term rental market as an example on the other side. So why do people choose short-term rentals more generally? Because one, either their yield is higher. So if you're in a good location, on average, from all the owners that we actually get a lot of information from, so we share information with our owners to try and create like a comparison of a net rental yield, because in a lot of our locations, especially in Europe, obviously we're entering the South African market this year, so we'll see, but the on average, short-term rental net yield, and in the net yield, just to let you know as well, we also include damages to properties as well, because that's something that people don't often look at in terms of, you look at the capital growth, look at the hybrid model. A lot of people don't consider actually the differences between how well in condition. There's maintenance and there's like actual condition of the property. So when we look at net rental yields, it's always at least 2.2 on average in most markets, and it could be up to like 2.5 to 3 times more net rental yield. So for example, where I am right now in Scotland, in Edinburgh, an average property that earns, let's say, 8,000 net rental yield pounds per year from a long-term rental will earn 24,000 on the short-term rental, which is quite a big gap. But then if you then go out of the kind of, let's say, like you said, really popular areas, we see a lot of clients that have had really bad experiences with long-term rental tenants, which leads to my next point. So when you look at the markets in comparison right now, we had a brief discussion before we started this wider debate today, or conversation today, which is we also manage long-term rentals, and very few of our tenants are paying full rent. And there's going to be a lot of unemployment for the next few years. So you also then have to look at the security around what is supposed to be a secure monthly fixed payment. So that's something to consider. So a lot of our existing clients, previous clients, and now clients that are coming to ask for our services are because they normally would sometimes, as you, and I think as Charles alluded to, the 1 million to 4 million, let's say, rand kind of bubble is a lot of it's about return, but then a hell of a lot of people in the market that we're in have properties for 4 million and up, and they really care about security and basically the property being taken care of. And obviously the difference between a property that's being cleaned once a week or twice a week sometimes and looked after, and a property that has to be at the highest maintenance level, always in good condition for guests that are paying good money to stay, is a big reason why people choose short-term rental. So just to let you know, our sales tactic, so when we talk to a new owner, we first of all explain to them that we are a property manager and we care about your property and we care about our guests. So the first decision you have to make is on the short-term rental is not just about the yield. The yield could be similar or a little bit less, a little bit more, but there are a lot of other factors that people look at when they look at the short-term rental market. And then just to allude to South Africa. So why South Africa? South Africa is essentially a huge destination, and it has been growing year on year. It's one of the biggest markets in the world in terms of spend on travel, destination travel between the months of November and March. And that's a huge time where a lot of, let's say, countries in Europe and around the world, America, really would like to travel. And in the short to medium term, what we're seeing already is that South Africa is one of the only markets where people are booking still in advance. So we see data from all the regions that we're interested in, and we're seeing still where people can booking like in advance already to return to South Africa like they did last year, because South Africa currently right now has not been hit very hard and has a low death rate. And as long as cancellation policies and stuff like that are in place, people are still booking in South Africa, and we are still seeing obviously a big opportunity in South Africa in terms of the longer term as like a travel destination and the longer term solution for property owner.
And I think just to add to that, obviously South African travel is heavily fueled by domestic travel, and I think it does have a huge impact in terms of how it'd be interesting to see how that happens COVID and post-COVID or post-lockdown, and how guys want to move. And I think it's a big thing of why strategically located areas are achieving a high short-term demand. But Mark, I just one quick thing I just want to ask you. I think what I find most interesting is how the models that you guys have implemented throughout Europe, where you've basically taken over the full operation of a development, where you've basically pooled all the different units together and utilized Airbnb and Bookings.com to provide almost a virtual hotel solution. One's concierge, cleaning done through one common entity, and just how you've seen higher yields for the owners. Can you maybe just elaborate on that?
Yeah, so essentially any what we call professional listings. So that's like if we've had an early discussion with a developer and taken a tactical decision to be the only manager in the property for lots of reasons. So it could be security is one of them, and just basically higher level of service for not just the short-term rental guests and the owners, but also for the people that live in the property as long-term tenants or actually live in the property as their primary residence. So essentially having one company has been good in terms of just the general customer service. And then obviously, first of all, when you have good customer service, guess what happens? Normally you get a higher price for your products, and you have a longer term customer and more return customers. And in a lot of these markets where these types of properties exist, there are a lot of return customers, a lot of business travel, a lot of staycation travel, where people basically come back to the same place, somewhere they can just retreat to and they're happy with. And also, yeah, in terms of the yield, because of the fact that all the reviews and all of the kind of marketing, and especially with a development, that you can quite nicely create a blended brand. Essentially, it's very appealing to the guests. So basically, what guests are looking for right now, if they can, is good value plus location, and then they say, right, I want the consistency of a hotel, but I want the flexibility in the space and the abilities that you have when you stay in a short-term rental apartment. So essentially what we found is developer plus professional property management company, short-term rental management company like ourselves, plus all the key platforms blended together creates basically the best output. So for example, in every location in Europe where we are, and in the States as well, when we look at the individual properties that we manage in a certain area versus a property that we have 10 units or 50 units or 100 units, the ones that obviously have higher density always create higher revenue, and it's just all about the way that you can advertise it. So yeah, that's the answer. And then also and linked to what you said about staycation, these properties are much more appealing for domestic travelers, and people forget that domestic travel is always the highest percentage, unless you're talking like a destination like an island, which is maybe 100%, 99% international travelers. Nearly every market has 60-70% domestic travel, and a lot of short-term rentals miss that because those people look for something a little bit more consistent and kind of classy, like a hotel. So therefore, a lot of short-term rental properties are only appealing and only focusing on international travelers and not actually on local business travel, which you have to do always one-to-one. It's all about creating direct campaigns to bring in that traffic, and it's very hard to do that as an individual property. So yeah.
Perfect. Mark, I'm going to bring Vivian in here. So Vivian, obviously at Property 360, you guys have got your ears very close to the ground in terms of what's happening. You're dealing with various different stakeholders. In your opinion, what trends do you think we're going to see coming out of life within the property industry post-COVID?
Steph, I just think no one really knows what's going to happen. So there's a lot of a great time to reimagine what it's going to be like. And the panel's been so optimistic, and it's made me quite excited and inspired about what could happen. Something that happened as lockdown have occurred in my block of flats, 50% left. They went to stay in outlying areas. I'm in the city. They went to stay in outlying areas. They went to go back to families. I think we might see more of a trend towards this going forward. Interestingly enough, in China, which is reopening, motor car sales have shot up. People don't want to be on public transport, and there's even more traffic now than pre-COVID because everyone's got their own car. So it's quite, what I'm trying to say is no one can really predict what's going to happen. And each region is quite different. I think we'll see more multi-generational living because of our financial predicaments many of us find ourselves in. And people want to be looking more at sustainability. I think that will become quite big. I also think the township markets, someone asked a question about the township markets. I think there's going to be a lot of reimagining of those township markets. I think there'll be a lot more development going into the township markets, and the infrastructure might be having a lot of work being done on the infrastructure, and bring in retail in a big way into the township markets where people don't have to travel these long distances to go to work, where work will be where they are. So those are some of the things that I've heard and been reimagined, and I'm looking forward to.
Perfect.
Thanks.
Sorry, Steph, can I just add something to that? Because something that what we've seen over the last 6 weeks, just talking into, Pat and the Collins group and Chris and his developments, is the ability, most of our developments now have fiber in. It's sort of like it's almost as standard as like electricity or water. And once you do that and you have the ability to, have seamless access and egress and communications and abilities to track and, control who's come in and case backtrack and all the rest of it, I think that's going to be something that, even talking into what Michael was saying about ease of access into sort of short-term lettings and all that, those type of facilities, I think we're going to see massive demand, because it's sort of seamless entry. Maybe even, we just put in, touchless biometric scanners to come in and out, or, like a Shesha tag that you see at the toll roads. Those types of access and egress systems into estates allow, almost no interaction. And I think that's something that I think we've seen a massive demand on that over the last 6 weeks, just talking to both what Michael and what Vivian was saying there.
So, Charles, a question here for you. If you were investing for yourself, what would you look for?
Look, I think convenience. Location is good. You've got to be close to where you work. I don't think people want to be using, South Africa, we don't, obviously the guys that we're talking about here, property buyers, typically don't use public transport. But also at the same time, we don't want to be sitting in cars journeying for an hour at a time to work. So I think convenience is going to be a big one. I think lifestyle, just the ability to walk down onto the beach, or and safety. I think safety is paramount. Low maintenance. And maybe it is multi-generational families buying, larger units and sharing them rather than, 2 or 3 property purchases from a family, i.e. grandkids, kids, and parents as an example. But I would always go with good property, good location, and good convenience. I think that's the recipe, what I would be looking to invest in. And in this country, obviously the necessity is security.
Graham, there are 2 questions that have come through about cash buying, and if I could just direct them to you. Firstly, the one is, what is the benefits of investing in cash versus taking a bond? And secondly, does capital gains tax apply to someone who buys with cash? And unfortunately, I think it does. Yeah. But if you could just clarify that.
I'll answer the second one first. There's no differentiation in capital gains tax as to whether you purchase with a loan or with cash. Okay, so it doesn't make any difference. The advantage, obviously, buying with cash is that it makes you a bit of a stronger purchaser. Okay, it might give you a bit of negotiating power with the seller, not having to have your sale subject to a bond, be able to pay cash. And also the incentive to the seller is that the transfer will go through a lot quicker if there's no bond to be registered, because it's normally the bond, with the exception of some local authorities, it's normally the bonds that drag the transfer process along, slow it down. So that's a bit of an incentive for a seller. But having said that, if you're buying a sectional title unit off plan, okay, I would always try and finance that purchase, simply because the bank offer a whole lot of expertise to you and protections to you that you won't have as a cash buyer. Okay, so for example, and the developers will hate me for saying this, but I'm normally on their side, that when before the bank will allow the registration to occur, they will send out inspectors to inspect the property, and they will spec it for you. And they won't allow the bank to release money until they, as the bank, are satisfied. Okay, so generally, I would say if you're a cash purchaser, that would be the advantage, with the seller. But if you're buying off plan, especially if you're a first-time buyer, then think about, taking a bond and using the bank's expertise to protect you.
Yeah, especially with the interest rates being so low, it makes a lot of sense to be using the bank's money at this time.
Yeah, absolutely.
Thanks, Graham. So just apologies. I know there have been a huge amount of questions. I think we've had over 30 questions that have come through, and we're not going to be able to get to all of them. Chris, just one question here from a first-time buyer. How do you go about vetting a tenant?
Vetting a tenant?
Correct.
Well, it depends. Okay, so generally you'd go through an agent. Depends whether you go through an agent or yourself. The agent does the various credit checks, bank statements, credit checks, etc. And they would vet it on your behalf. Obviously, a reputable estate agent was registered, and you would hope that they would do their job properly, so that you would know that the risk of them defaulting was low.
Perfect. And then Pat, just one question here that's come through in terms of immigration, the movement from Joburg into coastal properties. Is that something you're seeing on a day-to-day basis?
Steph, that is. We obviously, over the lockdown period, we've generated a lot of leads, a lot of inquiries, and more are coming from the Gauteng area in general. To date, in our estates here on the North Coast, we've probably had around 80-20 split between local purchasers, so people from within the Durban region versus from out of town, so the 20% being those from out of town. But I think with the airport now being on the North Coast, potentially someone who needs to work in Johannesburg, instead of spending an hour in the car every day, can hop on an airplane and be in Joburg in 50 minutes sitting on the airplane. And so we are getting a lot of inquiries from people who are wanting to semigrate, people who are wanting to do a 3 or 4 day work week in Joburg, but have the lifestyle for them and their families on weekends on the North Coast here.
Perfect, agreed. So everyone, I think we've always said we want to try and keep this to an hour. It's been an hour, and we really appreciate everyone's feedback. There are a lot of questions we probably haven't got through, or maybe have touched on at various different points. What we are going to do is we're going to be loading this as a blog post on our website. We'll be sending each of you guys a mail with the live recording of this, and trying to answer any questions that we haven't been able to answer, but obviously giving you the opportunity to go through this again. So I think just going to maybe just pass on to panel if there are any passing thoughts that any of you guys want to share, but just before we knock off.
Well, Steph, from my side, I think, using a home comparison service provider, bond originator, going through the tough times that home buyers are going to be facing over the next couple of months is probably a really good idea. You've got experts at your side and who can secure you home finance, which might be a little bit more tricky going forward than it has been in the past.
Perfect, thanks. So I think a big thank you to our panel. I think it's been hugely informative, and I think the comments and the feedback that have been sent, people really thanking you for your input, and I think it's been really, really insightful. And again, I think one really only scrapes the tip of the iceberg when it comes to these type of things, and really there's opportunities to cover these topics in more detail going forward. So our next topic or our next webinar will be next Tuesday at 12 o'clock, where we're going to be doing the second edition of our retirement focus. There was a huge amount of interest from the last retirement panel. So most of that panel will be back next Tuesday and really digging deeper into retirement as a whole, but focusing very specifically on retirement within KZN. Lots of different factors that the guys spoke about why KZN really has differentiated itself from a retirement perspective. And so we look forward to going through that with you then. And yeah, I hope you're all well and safe during day 47 of lockdown, and we hope you all have a wonderful week going forward. But thanks again for everyone's time, and thanks to those of you who have joined us today.
Thanks, Dave.
Thank you.
Thanks,
Guys.
Thank you.
Cheers.
Bye.
Cheers.
Bye.
Bye. Thank you.